Ladies and gentlemen, welcome to the second part of the video lecture on option valuation, in which we are going to understand a condition known as the put-call parity condition. As a precursor to that, we are going to start by looking at a concept known as protective put. First of all, a protective put is also known by the name of a married put, and in the world of options contracts, the world is a little better than the human world, I would say, because there is no divorced put in the case in the context of options. So a protective put, also known as a married put, is constructed, ladies and gentlemen, when you have an underlying asset like a share of stock. So for example, you buy a share of stock and then you are bothered about the fact that the prices of shares might fall later, causing you to lose your investment value. So in order to protect yourself against that loss, you also buy simultaneously a put option on the same stock, and that protects you against a decline in the value of the underlying asset, in this case the underlying asset being a share of stock, because you will remember from the previous session that a put option essentially locks in your selling price. So in the event of the share of stock losing its value in the market, you would already have reserved a right to sell at a fixed exercise price in the case of a put option. So you will also recall from the previous session that when we buy options contracts, we pay option premium to buy the options contract. So in this context, when you buy a put option and pay the option premium for that, you are paying that premium to limit your downside risk. By downside risk, I mean the loss of value in case the stock prices fall. So it would be similar to paying an insurance premium to pay against to protect against a potential loss. Let us understand this concept a little better by taking an example. So in this example, we are assuming a Citigroup stock which is going for $45, and you buy that stock. At the same time, to protect yourself against a potential loss in the value of Citigroup stock, you purchase a put option with a strike price of $40. So essentially you're locking in a selling price of $40. So even if the Citigroup stock goes down in value to, let's say, $25 or $30, you would still have the right to sell it for $40 to the person from whom you bought the put option. In order to get that put option, ladies and gentlemen, you pay a premium of $1.80, and this option expires in 1 year time, at which time you plan to sell this stock. The question is, what can be your payoffs on this position just before maturity? To understand that, let us prepare a little table where we are looking at the protective put strategy. You're seeing the title of the slide. We are going to study the payoffs of a protective put, which is basically a combination of a stock and a put option on the same stock. So you have two things with you. You have a Citigroup stock with you, and you also have a put option on the Citigroup stock. In this table, you see a few columns. The first column talks about the stock price, in which, as we go on filling up this table, we are going to study different scenarios where we are going to assume different stock prices. The second column has a title of put value, so we are going to record the put value against each stock price as we go further. Then the third column will record the combined value of the position, because you have a position which comprises of two things. You have a stock and a put option on the same stock. So we are going to record the combined value of this position in the third column. And in the final column, we are going to record the total gain or loss on the position. So let's assume something. Let's assume by assuming a stock price of $25. So let me pick up a pen and write here $25. 25. So if the stock price is 25 and the strike price is $40, what would be the intrinsic value of the put? You will remember from the previous session that the intrinsic value of a put option is given by E minus S. So if you do E minus S, let's just do that here once. E minus S, E minus S. So we have seen that the question gives us an exercise price of $40, and the stock price we have assumed at the moment is 25, which means that the intrinsic value of the put option at the moment is 40 minus 25, which will give us $15. So we can write here $15 is the put value. And the combined value would be the sum total of the first two columns. So 25 plus 15 would give us 40. In the final column, we have to record our total gain or loss in this situation. So what do we have? We have a combined value of $40. So let's write that here, 40. And to get to this 40, what did we spend? We bought a share of stock which was worth $45, right? So I'm just writing 45 here. So we bought a stock at that time, it cost us $45. And at the same time, we bought a put option on the same stock which cost us $1.80. You could rewind and see from the previous slide. So to set up the position, we spent $46.80. $46.80 was our expense. And the combined value of our position is $40. So the total gain or loss in this case would be 40 minus 46.8. And that would give us a loss of $6.80. So let me just clear the space and write that. Erasing this stuff and getting the pen back. So 40 minus 46.8 would give us a loss of $6.80. Let us say in the next row, the stock price rises to $30. So let's just write here 30 and reevaluate our position. So if the stock price rises to $30, what would be the put value? Again, E minus S. The exercise price is 40, right? And the stock price is now 30. So 40 minus 30 is going to give us 10. So the put option will have an intrinsic value of $10. And the combined value will be again $40. And the total gain or loss will remain the same, 40 minus 46.8, which is minus 6.8. Let's do one more row. Let's say $35 is the stock price. In this case, what will be the intrinsic value of the put option? So we'll think about E minus S again. The exercise price is $40 and the stock price we have assumed it to be equal to 35. So 45 minus 35 is going to give us 5. That will be the put value. The combined value will be again 40, and that will mean that our total gain or loss will be again $6.80 loss. Let us assume one more value. Let us say the stock price rises to, let's make up something, $50. $50. So now what is going to be E minus S, because we are in the second column interested in writing the intrinsic value of the put option. So E minus S is going to give us exercise price is 40, stock price is 50. So 40 minus 50 is minus 10. And we saw in the previous video session that the intrinsic value of an options contract cannot be negative. At worst, it could be 0. Remember, the intrinsic value of a put option would be a maximum of either 0 or E minus S. So as long as E minus S was positive, we took those positives happily, 15, 10, 5. But now that it has turned negative, we just say that the put is worthless. So we just record a value of 0, and that will give us our combined value of 50 plus 0 equal to 50. And the total gain or loss would be now 50 minus, and we had spent $46.80 to set up our position. So 46.8, difficult to write here, 46.8. And that is going to give us $3.20 positive. So now we have a gain. So let's assume one more, $55 stock price, $55. So the put value is going to be again 0 because E minus S will be again 0. And the combined value will be 55. And the total gain or loss on our position will be 55 minus 46.8. And that is going to give us $8.20. And we have room for, I guess, one more scenario. So let's write here $60. So the stock price rises to 60. Put value will remain 0 now because it is, well, if you remember, out of the money. And the total combined value is going to be 60 plus 0, 60. And then the total gain or loss will be 60 minus 46.8. And that would give us 60 minus 46.8 would give you $13.20. So what do you observe from this table? You observe, let's change colors for a moment. You observe that up until this point, you were losing $6.80 and your loss was limited to $6.80. Under no case you lost more than $6.80. But when you started gaining, see how your gains started adding up. $3.20, then it rose to $8.20, then it rose to $13.20, and if we had more space and the stock price kept on rising, this gain would keep on rising here. So this is the area where you're gaining, and practically speaking, the gain potential is unlimited. That is what we spoke about in the last session also, that with options contracts, your losses are limited, but the upside gain is unlimited. So you can keep on earning more and more and more as the stock price goes on rising in the market. So these are the possible payoffs from a protective put strategy. So what I'm going to do is I'm going to quickly erase all the content that I have written out here, and I'm going to show you the table one more time in a neat fashion so that you can see it in a better way and appreciate the underlying concept. So let me try to do this as fast as I can so that we have space to play on the slideshow. So just bear with me for a few seconds and it will be right there. Right, so these are the various scenarios we were talking about. So you can observe when you play the video, you can pause and look at it or rewind and see it again. So you see, as long as we are in the loss-making situation, which is highlighted in red color, the loss is never exceeding $6.80. But when we move into the gain territory, which is the green territory, the gains keep on rising, starting from 3.2, moving to 8.2, then moving to 13.2. And if there was more space and we accommodated another higher stock price, the gain would even be higher. So let's keep this table in mind, and let's keep this fact in mind that when you set up a protective put by buying a stock and also buying a put option on the same stock, these are the possible payoff scenarios with the data that we have assumed. Let me go back and show you the data one more time, just in case you want to understand this as we go forward a little better. So the things to keep in mind as you play on this video is that we set up the strategy by buying a stock for $45 and at the same time buying a put option on the same stock by paying $1.80 as the option premium. And this option came with a strike price of $40 and expiry period of 1 year. So now that we have looked at the protective put strategy and its possible payoffs here, let us consider an alternative strategy that can hopefully give us the same kind of payoffs. So we are trying to replicate a protective put now by doing a couple of steps. At number one, what we are going to do is that we are going to buy a call option on the stock. So we are not buying the stock, we are starting afresh. We have the data with us that there is a Citigroup stock which sells for $45. There is an option, there's a put option which goes for $1.80 and comes with the same with the exercise price of $40 and so on. But instead of buying the stock and then buying the put option on the same stock, what we are starting with is that we are going ahead and straight away buying a call option on the stock, which gives us a right to buy the stock. So a call option, you will remember, grants you the right to buy the shares after the stipulated period of time, in case it's a European option. But then what you need to keep in mind is that after that stipulated period of time is over and you really do want to exercise your option, exercising the option will mean that you will have to put up funds to buy the stock for the exercise price of $40. We are assuming the same exercise price for the call option, also $40, as it was in the put option. So let's say the stipulated time period of 1 year is over and you want to exercise your call option now. Now you will need to come up with $40 to actually exercise the call and buy the shares using the call option. Right. So let's assume a sample scenario that after 1 year the market price of this share is $50. You will then feel motivated to exercise this option because you can get it at a cheaper price. You will save $10 because something which is worth 50 you can buy for 40. The only thing, as I mentioned before, is that after 1 year, when the option matures, you will need $40 to make the purchase. And as a rational investor and a cautious investor, you would like to plan in advance. That is a better thing to do. So you know upfront that if when the option matures and if you wish to exercise the option, the call option at that time, you will need $40 after 1 year's time. So it makes sense now to invest at this point in time, to invest some money which is going to grow into $40 by the time you're ready to exercise the option. So if you're investing some money now which has to grow into $40, we will need an interest rate at which it grows, and for that purpose we are going to assume a risk-free rate, for which we know that treasury bill rates can be used as a proxy. For those of you who are doing money and capital markets course also, you know what a treasury bill is. For those of you who do not know treasury bills, they are short-term debt instruments issued by the treasury of a country. So we are going to assume the T-bill rate as the risk-free rate. So we can invest some money, we don't know yet what money we need to invest, at the risk-free rate so that it grows into $40 by the end of 1 year, at which time if we want to exercise the option, call option, we can use the $40 because that investment will mature, and we can withdraw $40 and use those $40 to buy the share by using the call option. However, if we are in a position where we realize that we don't want to exercise the call option, we still have our $40 with us, so there's no loss anyway. So let's assume an interest rate, let's say 2.5% per annum. And so the question becomes, if the interest rate is 2.5% per annum, how much do you need to invest today at this interest rate to end up with $40 in 1 year? So this becomes a simple time value question, isn't that so? So this becomes the future value. This is the future value that we intend to attain after 1 year. This becomes the time, which is the n, and this is n, very poorly written n, and this becomes the interest rate, let's call it r. So basically what we are wanting to do is to find out the present value. That is what we need to find out. How much do you need to invest? How much do you need to invest now so that it grows into 40 after 1 year at a 2.5% interest rate? So if you remember, present value is nothing but equal to the future value divided by 1 plus r raised to the power of n. So you could substitute the numbers here. Future value is 40, 1 plus r, so 1 plus 2.5% would be written as 0.025, and because the time is 1 year, we could just raise it to the power of 1. So if you solve this, you are going to get $39.02. So what we have answered here is that if we invest $39.02 today at an interest rate, risk-free interest rate of 2.5%, and leave that investment running for a year, after a year this $39.02 would become $40, at which time we could use this $40 to exercise the call option if we want, or if we don't want to exercise the call option, then this $40 is ours to keep anyway. So just to recap what we did, here is the description of that. So $40 was the future value and we are supposed to find the present value. Therefore, we have computed the present value by doing this. You could also use your financial calculator to do this, where FV would be 40, I over Y would be 2.5, N would be 1, and you would compute the present value. So this is simply telling us that we invest that if we invest $39.02 today for a year, at 2.5%, it will grow to $40 in 1 year's time. And then we can use these $40 to buy the shares, buy the share by exercising the call option. And of course, if you don't want to exercise the call option, you will still have the maturity value of your investment with you to keep. So we can denote the various things by using letters. We can denote a call option by letter C and the exercise price by E. So what does our strategy look like? What are we doing really? We are doing two things. We are buying a call option. So I'm writing a C. And at the same time, what we are doing is we are investing the present value of exercise price. Remember, the exercise price was $40 and we are investing the present value of exercise price, which is $39.02. This one here, we computed that. So this is the strategy. Buy a call option and invest the present value of the exercise price. So you will see that here also written here down at the bottom of the slide. This is the alternative strategy. What was the first strategy, by the way? The first strategy was that you buy a share of stock. So that is denoted by S. And at the same time, well, very, very horrible looking S. So let's just forget about this. Let's write this side S, buying a share of stock, and at the same time buying a put option on the same stock. So S plus P was the first strategy, and we saw the payoffs of that strategy a little while ago. Now we have an alternative strategy, which is buying a call option here and investing an amount equal to present value of the exercise price. And in order to compare these two strategies, we want to give ourselves the same start. So let's assume, you'll shortly know what I mean by giving ourselves the same start. Let's assume there's a call option on the Citigroup stock, which is selling for $7.78. So this is the option premium for the call option, and the T-bill rate is 2.5%, which we assumed a little while ago. So I said we want to look at the same investment. We want to have the same start. It means that we want our investment in the process to remain equal to $46.80. Remember, in the previous strategy cost us $46.80. Why? Because we had gone ahead and purchased a stock for $45, and at the same time we had purchased a put option and paid an option premium of $1.80, meaning that our total investment in the process was $46.80. So we want to give ourselves the same start so that we can then compare that if in the alternative strategy also we invest $46.80, what are going to be our payoffs? So if we want to keep the total investment in this strategy also $46.80, and we know that one part of this strategy is going to cost us $39.02, what would be the price of the call option? It would be $7.78, as we have seen before. So we invest $39.02 in T-bills. So you can see it checks out $39.02 here. And we had also computed the same thing by using the present value here. If you computed the present value of the exercise price, that also came equal to $39.02. So everything checks out, and we are ready to look at the payoffs of this particular strategy. To look at the payoffs for this alternative strategy, we again have a table. Let's understand the headings first. The first column will record the possible stock prices, so we will build the scenarios here. In the second column, we will record the value of the call option. In the third column, we will record the value of our risk-free investment, the maturity value of our risk-free investment. We know that already. the maturity value of our risk-free investment will be $40, because remember, we are investing $39.02 and it is going to mature into $40 in 1 year's time at the risk-free rate. So the value of the risk-free investment, the maturity value that is going to be $40. In the next column, we are going to record the combined value or total value, and then in the final column, we are going to record the total gain or loss. So I'm not going to scribble anything. I'm just going to present to you the first scenario and we will talk about it. Once that settles into your understanding, the rest of the table should be fairly simple to follow. Let's assume a starting stock price of $25. So let's look at the values that appear in the row. So if the stock price is $25, remember this time in this strategy we do not have the stock with us. In the previous strategy, when we were finding the combined value, what was happening? We had the stock, if the stock price was $25 and we had the stock, then we also had a put option with it, and that put option was worth how much? It was worth, I think, $15 at that time. So we had two things in that strategy. A stock worth $25 in the first row, and the put was worth $15, so that the combined value was $40. In this case, we do not have the stock because this strategy, let's write that here again. Let me choose a black color here. This strategy is that we are going to buy a call option, which gives us a right to buy the stock, but we do not have the stock as of now. It gives us the right to buy the stock if we want after the option matures after 1 year. At the moment, we only have the call option and we have our investment, which is equal to the present value of the exercise price. These are the two things that we have. So once the stock price is $25, what is going to be the intrinsic value of the call option? You see a value equal to 0 written there, because now you will remember from the previous session that the intrinsic value of the call option can be a maximum of two numbers. Either it could be 0 if things are not going good, or it could be S minus E. So maximum of 2. 0 or S minus E. So if the stock price is 25, what is S minus E going to be equal to? Stock price is 25 and the exercise price is 40. So 25 minus 40 is going to give you minus 15. And we know that the payoffs cannot be negative for options contracts. So therefore we use a 0 as value, because the choice is really between 0 and S minus E. So the call is worthless, and we have an investment which has a maturity value of $40. So this item here, this one, is the sum total of this item and this item. So 0 plus 40 gives us 40. And if we had spent $46.80 to set up this strategy, the gain or loss would be minus 6.8, because 40 minus 46.8 would give you minus 6.8. Now, if you look at the next row where we have assumed a stock price of 30, you will realize that the call will still remain worthless, because if you perform the operation S minus E, you will realize that it will work out to be 30 minus 40, that will be minus 10. So it will be 0 here, and the value of the risk-free investment, the maturity value of it is $40. So the combined value is 0 plus 40 equals 40. And the gain or loss remains minus 6.8. So we are losing $6.80 again. Likewise, if you increase the stock price to $35, the call still remains worthless, because S minus E will still be in the negative territory, because 35 minus 40 will give you minus 5, which will mean that along with your maturity value of your risk-free investment, your total value will be 0 plus 40, 40, and the loss will be $6.80. The same scenario will obtain for a stock price of $40. And when the stock price becomes 45, what do you see? When the stock price is 45 and you perform the operation S minus E, where S is equal to 45 and E is equal to 40, S minus E will be equal to 45 minus 40, and the call value will be $5 here, and you will have the maturity value of your risk-free investment equals $40. So the total value or the combined value of the position is 45 now. What went wrong? 45. $45, which will mean that your loss will now start shrinking from $6.80. It shrinks to $1.80 because 45 minus 46.8 would give you minus 1.8. And then if the stock price goes up to $50, you see that we are in a gaining position of $3.20, sorry. At $55 stock price, we are gaining $8.20. At $60, we are gaining $13.20. So these are exactly the same payoffs as we obtained with the previous strategy known as the protective put. So once we know that the both strategies give us the same payoffs in the end, they also must cost the same in the beginning, right? So that is what leads us to the put call parity condition. So let's look at what the put call parity condition is. So I just said that if two positions are worth the same at the end, they must also cost the same in the beginning. Therefore, we can write down the put call parity condition as follows. On the left hand side of the equation that you're seeing the protective put, where you have a share of stock and the put option on the same stock, S plus P. On the right hand side of the equation, you have the alternative strategy, where you have a call option and the present value of the exercise price. So this put call parity condition will obtain, and if it does not hold, then there is going to be an arbitrage opportunity, of course, where we know that arbitrage simply means you buy whatever is cheap and you sell whatever is high. Ladies and gentlemen, we can use the put call parity condition to find the value of any of the variables given the other three variables. You will realize that if you look at the equation, there are four variables. S is 1, P is 2, C is 3, and present value of the exercise is the fourth variable. So if you know the three variables, you can find the fourth one. So let's take up a little example here. It says you have looked in the financial press and have found the following information, that the current stock price is $50, so that is S in our framework. The put price is equal to $1.15, that is the P in our framework. The exercise price of this put option is $45, so that is the E in our framework. The risk-free rate is 5%, that is the R, which we will use for discounting purposes, and the expiration is 1 year. The question is, what is the call price? So it is simply a matter of substituting the numbers in the put call parity condition and solve for the unknown. So let's write the put call parity condition here quickly. It's equal to S plus P. Well, I tried to write an S, it looks like a 5 though. S plus P equals C plus the PV of E. C plus the PV of E. So let's just substitute the numbers. Stock price is $50. So let's just write that here, 50. The put value is given to us, that is $1.15. So let's write that here, $1.15, 1.15. And then call value is not known. That is something we are supposed to find out. So that remains a C. And then we can write the present value of the exercise price. So what the exercise price is, $45 is the exercise price. So we can write 45 and compute its present value by dividing it by 1 plus the interest rate, 0.05, and then raising it to the power of time, where time is equal to 1 year, because the expiration is in 1 year, so raised to the power of 1. So I believe all of us can solve this to find out the value of the call option. 50 plus 1.15 is equal to C plus the present value of $45. So you will see that here, and if you solve it, your result is going to be $8.29 as the call price. So that is fairly simple. The only thing that we need to be aware of now as we go forward is that in the world of options contracts, what we use is continuous discounting and not regular discrete discounting like we have done here. So let me highlight a thing for you. This item here, oh Lord, this item here, let me see if I can manage to highlight it. This item here is an example of discrete discounting. What we are supposed to do with options contracts is that we are supposed to use continuous discounting. I hope you remember that from your time value of money, which you would have done in the Financial Management 1 course. What I'm going to do is that I'm going to restate the put-call parity condition using continuous discounting, and then we will take an example or two on how to use continuous discounting. Continuous discounting, if we use the put-call parity condition, is going to start to look like this. So the left-hand side has no change, you see. It remains the protective put, S plus P. On the right-hand side also, well, this item is the same, this item is the same. On the right-hand side, C is the same. This item looks a little different because the exercise price has been discounted on a continuous basis. So when we do continuous discounting, what we do is, let me write it both ways for you. Let me just break this into two parts here. So on this side, on the left hand side, we will write our discrete discounting, discrete, D for discrete. And on the right hand side, we will look at continuous discounting, C for continuous. So when we do discrete discounting and we want to find the present value of something, what we do is this. We write down our future value and we divide it by 1 plus the discount rate, let it be R, raised to the power of N. So that is what we do in discrete discounting. In continuous discounting, if we want to find out the present value, so let me write that here again, present value will be equal to the future value. And if you want to discount it on a continuous basis, you could write it as follows. You could divide this by E, the mathematical constant E, raised to the power of minus R times the time T. R times the time T. So see, the denominator is different in both cases. In the case of discrete discounting, we have 1 plus R raised to the power of, well, you could call it T for the sake of similarity. Let me just erase that and write T here so that there is no confusion. So 1 plus R raised to the power of T is the denominator in the first case. In the case of continuous discounting, you have the denominator E raised to the power of minus R times T, where E is the mathematical constant. And we can use our calculators, scientific calculator or the financial calculator, to find out the value of E raised to the power of something. You can write the continuous discounting as this, or if you this had to be positive here, E raised to the power of R times T. If you want to take this guy upstairs, you can write it as FV multiplied by E, but because now you're going to write it in the numerator, the exponent will become negative, so it will become minus R times T, minus R times T. And that is what you see here. So either formulation is okay. Either you can divide the future value by E raised to the power of R times T, or you can multiply the future value of future value with E raised to the power of minus R times T. So let's take a simple example for continuous discounting. So the question says, what is the present value of $100 to be received in 3 months if the required return is 8% per annum and using continuous compounding or discounting? So if you are computing the present value, you are writing PV is equal to 100 is the future value. So we write that here. And then we say multiplied by E raised to the power of the interest rate R, which is minus 8% now here, 0.08, minus 0.08 multiplied by 3 months. So another thing to note here is that when you use the time here in the exponent, it is always supposed to be in terms of years. So 3 months is going to be how many years? 3 months is going to be 3 over 12 years, because there are 12 months in a year. So multiplied by 3 over 12, which will basically give you 1 over 4. So this boils down to 100 multiplied by e raised to the power of minus 0.08 multiplied by 1 over 4 multiplied by 1 over 4. So which will basically mean now 100 multiplied by e raised to the power of minus 0.08 times 1 over 4 will mean minus 0.08 divided by 4. So that will be equal to 0.02, I believe. E raised to the power of minus 0.02. So it boils down to now finding out the value of e raised to the power of minus 0.02. Oh God, minus 0.02. It's very difficult to write this stuff. It continuously irritates me. Let me get the pen back. Minus 0.02. Oh no. Oh, minus 0.02. Right. Okay, so how to do this on your calculator is now what I'm doing is I'm using, now though you can't see it, I'm using my financial calculator, Texas Instruments, and what I'm doing is I am first of all typing in 0.02, and then in the last row of the buttons I see a plus minus sign. I will press that to make it minus 0.02. Once I do this, then in the first column of my keys on the calculator, I see a button which says second, to invoke the second function. It is the yellow color button. So I'm pressing that button, and then in the same column I look for a key which says ln, and on the top of it is written e to the power of x. So I'm going to press that ln button, which stands for the natural log, by the way. And when I press that, my calculator is showing me a value equal to 0.9801. So which means that e raised to the power of minus 0.02 is equal to 0.9801. So we can write that result here, 100 multiplied by 0.9801. So it's easy to see that on a continuous discounting basis, the present value of this $100 is equal to, well, this is 9.801, or no, sorry, 0.9801. So when you multiply this with 100, you are going to get $98.01 as your result. $98.01. $98.01. Difficult to write. Okay. So this is how continuous discounting is done. Things to remember: E is a mathematical constant, and you don't need to really know its value. What you need to know is how to handle it on the calculator. And the other thing is that the time is always supposed to be denoted in terms of years. So if it's given to you in months, you will need to divide the given months by 12 to get it into years. If it was given to you in terms of days, then you would divide the number of days by the number of days in a year, which is 365. If the time was given to you in terms of weeks, then you would divide those weeks by the number of weeks in a year, that is 52, and that will convert it into years, which you can then use in the formula. Okay. Right, so this is the neater version of it which just popped up. 100 multiplied by e raised to the power of 0.08 negative times 3 over 12, and that gives us $98.01 or 2 cents approximately. Right. So let's look at another example, because you need to look at this kind of a computation as well. We are assuming a stock price of $60, and then we have an exercise price on an option which is $65, and the option that we are talking about is a call option which costs $3, so this is the option premium. Then we have a put option which costs us $7, so that's the put premium. And then the expiry time is given to us for both options, that is equal to 6 months. The question asks us about finding the risk-free rate implied by these prices. So if we are to find out the risk-free rate implied by these prices given here, we can again use the put call parity condition to find out the one unknown, that is the R in this case. But please pay attention to the process that we are going to follow, and I'm hoping that that I will be able to write properly on the screen to indicate that to you. So let me start by first of all writing the put call parity. S plus P equals the call plus the present value of the exercise price, and remember we are using continuous discounting. So let's just fill in the numbers and see. Stock price 60 plus the put value 7 is equal to the call value 3 plus we have to write the present value of the exercise price using continuous discounting. So we write the exercise price E, which has a value of $65 here, and now we have to multiply this 65 by E raised to the power of minus R. R is something that we need to calculate, so minus R as it is, multiplied by time, and time is given to us as 6 months, which means half a year, because if you divide these number of months by the number of months in a year, you will get 6 over 12, and that is nothing but 1 over 2, and 1 over 2 is nothing but equal to 0.5. So basically in the exponent we can write 0.5 times R. So let me just erase this and write simply 0.5 times R. 0.5 times R. E raised to the power of minus 0.5 minus 0.5 times R. And it is the R that we need to solve for. If you don't remember how we got the minus 0.5, it's because we are talking about half a year, and half a year is written as 0.5 years. Why half a year? Because the expiration is in 6 months time. So let's continue solving this in this space that I have. Let me see how best I can write. So 60 plus 7 on the left hand side will give me 67. On the right hand side, what I have is 3 plus 65 multiplied by E raised to the power of minus 0.5 R. So I'm going to ask this 3 to go over to the other side. So we will have 67 minus 3 on the left hand side, which will give me 64. 64 equals 65 times E raised to the power minus 0.5 times R. Now I can look at this 65 and ask it to go over to the other side here. This 65 can go over to the other side here, and which will mean that on the other side, that is on the left hand side, it's going to go and get divided. So what I'm going to have here is 64 divided by 65 is equal to E raised to the power of minus 0.5 times R, minus 0.5 times R. Horrible looking R, by the way. Minus 0.5 times R. Okay, not Not very good either, but well, I hope you understand what I'm writing. 64 divided by 65 is equal to e raised to the power minus 0.5 times r. So if we work out 64 divided by 65, I'm going to do that on my calculator, though you're not seeing it. So 64 divided by 65 is going to give me 0.9846. So I'm writing here 0.9846. And look at the right hand side. I hope you know the logarithmic rules a little bit. If you don't, well, let me just write e raised to the power minus 0.5 r for now. Right, and I need to give myself a little bit space, so I'm erasing from this side. So we will continue after I have enough space to write. So what we have now is 0.9846 equals e raised to the power minus 0.5 r. What we are going to do at this stage is, and keep a note of it in your mind, we are going to take the natural log of both sides. So what we are going to write is natural log, so ln of 0.989846, and if you take the natural log on the right hand side, what will happen is that the exponent part will be written like this, minus 0.5 r, and the base, which is e, we will write the natural log of that, minus 0.5 r times natural log of e. And one good thing about natural log of e is that it is always equal to 1. So basically the right hand side is going to collapse into minus 0.5 times r. So all that we are left to do is, now on the left hand side we can find out what is the value of the natural log of 0.9846 and then do the transposition to just solve for the value of r. So what I'm doing is I'm opening my calculator again. What I'm using is the Texas Instruments BA2 Plus financial calculator, and I am computing the natural log of 0.9846 as follows. I'm typing in 0.9846, and once I see that on my display, I go to the first column of my keys, and in the first column I see a key which says LN. I am going to press that, and what I see is that my calculator returns me a value which is equal to minus 0.0155. Right, so I'm computing the value of the natural log of 0.9846. To do that, what I'm doing is I'm pressing 0.9846, and then I'm pressing the LN button in the first column of my keys here, and the result that I see on display is minus 0.0155. So I'm going to write that here, minus 0.0155 equal to minus 0.5 times r, and ln of e is equal to 1, so we just leave it like that. And now we can very easily calculate the value of r. Now what we have is that both sides are negative, so the minus sign cancels out with the minus sign, and r will be equal to, let's see if I can write that in the remaining space, r will be equal to 0.0155 divided by 0.5, and let me quickly check it on the calculator what it's going to give me. Divided by 0.5 is going to give me approximately 3.1%. 0.03103 is what I see on my calculator, so that's approximately 3.1% is the rate here. So this is our result. So you can pause the video or rewind it and look at the steps that I've discussed with you and try and compute it on your own. What we are going to do next is take up an example which talks about well, this was the solution here, 3.1%, but it's quite overwritten by my scribbling now. But as long as you can understand, well, I can clear this off quickly so that when you play the video, you can see the clearer version of it also. It will just take a moment, so please bear with me. After this, what we are going to do is to take up an example when the put-call parity condition does not hold. You can use it to gain a risk-free profit using an arbitrage process. So I'm going to set up a problem and show that to you in a moment. All right, so I've cleared this, so you can follow the example's solution from here as well. Right, so this is some data here, and we are going to use this data to see whether the put-call parity condition holds. If it doesn't hold, there is going to be an arbitrage possibility, and if there is an arbitrage possibility, we can exploit it for our advantage. So let's look at the information. An investor has just obtained the following quotes for European options on a stock which is worth $30. So the stock price S is 30. When the 3-month risk-free rate is 10% per annum, so we are talking about a time frame of 3 months. So T is equal to 3 months, which will be in terms of number of years 3 over 12 equals 1 over 4 equals 0.25. So it's a quarter of a year. And the rate assumed is 10% per annum, very high for a risk-free rate, but that's how the problem is set up anyway. So, and then we have the fact that both options, a call option and a put option, have a strike price of $30. So that is our E. The European call price or call premium is $3, and the put price is $1.75. What it asks us to do is to determine whether the prices are conforming to the put-call parity rule, and if there is a violation, you're asked to suggest a trading strategy that is going to generate riskless arbitrage profit. So now that you have gotten a hang of what is put-call parity condition and how to use it by substituting the numbers, I don't think I need to scribble on the screen. I can simply show you the solution and walk you through it. So the put-call parity condition is S plus P is equal to the call price plus the present value of the exercise price. So on the right hand side you see that capital E is the exercise price and the small e is that mathematical constant which is raised to minus R times T. So if you substitute the numbers, you will see, you remember from the previous slide, the stock price is $30 here, and the put price is 1.75 here. So the left hand side would look like 30 plus 1.75, and the right hand side we will look like you have the call option which is $3 and plus the present value of the exercise price. Exercise price is right here, $30. So 30 exercise price multiplied by the small e raised to the power of minus R times T. So R is 3 months, which we said would be equal to a quarter of a year, which can be written as 0.25. That is the time, and multiplied by R, which is 10%, so 0.1. So this is the right hand side. So this is the right hand side. This is the left hand side, and we need to check whether both these are equal or not. So let us see in a neat fashion on the following slide. So we have substituted, and where there's supposed to be an equality sign, I've put a question mark because we don't know yet whether both sides are equal or not. And when you run the computation, you realize that the left hand side is equal to 30 plus 1.75, that gives you 31.75, and the right hand side works out to be equal to 3 plus 29.2593, and that gives us 31.75. Obviously is not equal to 32.2593, which means that the put call parity condition is violated, and we can use this to our advantage and get some profit. maybe some of you might be interested in knowing how we got this number here. So I can try and scribble on the side here and try to solve this for you so that you can see and take notes. So the right hand side is equal to 3 plus, I'm just solving for this item here, 30 multiplied by e raised to the power minus r, which is 0.1, times the time, which is 3 over 12, means 0.25. So what I'm going to do on the calculator, because I cannot show you what I'm doing, I'm simply going to keep saying aloud what I'm doing so that you can follow my steps. So the first thing that I'm doing is I'm multiplying 0.1 by 0.25, and that gives me 0.025. But because I need to keep my exponent as negative, I look at the last row of my Texas Instruments BA2 Plus calculator, where I see a plus minus sign. I press that so that the display now changes to minus 0.025, and then I'm pressing the second function key, which is the yellow button in the first column of your keys. I'm pressing that, and then I'm pressing the button which says ln, and the following value is returned to me, 0.9753. Right, so e raised to the power of minus 0.1 times 0.25 will be computed as follows. What I'm doing is I'm pressing 0.1 and then I'm multiplying this with 0.25 and then pressing equals. The display says now 0.025, but I want a negative number, so I press the plus minus button here. Then because I want to raise this number to the power of e, I press the second function and then I press the button on which ln is written, this one here, and the display changes to 0.9753. So I'm going to record this here, 30 multiplied by 0.9753 and 53, oh Lord, 53, 53, I just can't get to write the 3. Alright, so I'm going to now multiply the 30 with 0.9753. And what I get is 29.2592, so if I round it off, it will be equal to 29.2593. So this item here is equal to this, the item in the box. So now that we have figured out that the left hand side is not equal to the right hand side, we can conclude that the put call parity condition is violated here. And therefore our common sense tells us that we want to buy whatever is cheap by selling whatever is expensive. In other words, we can finance our purchase by selling the expensive side. So let's see how we can accomplish that. So we want to finance our purchase by first of all getting some money by selling the expensive side. So what is the expensive side here? The expensive side is the right hand side, this one. So if we sell this, we are going to obtain $32.2593 and we can use $31.75 out of that to finance our purchase. So let's see the steps that we need to take. On the right hand side, which is the expensive side, what do we have? What are the components? We have a call option. So we have a C, call option. So we are going to sell a call because we have decided to sell the expensive side. So we are going to sell a call option. And then the second component is the present value of the exercise price. Remember what we usually do when we set up the strategy. What did we do? We said that we are going to invest the present value of the exercise price and let it grow so that by the time we reach a point where we need to decide whether we are going to exercise the option or not, the investment would have matured at a risk-free rate and we would have obtained a value which is equal to the exercise price. So we decided to invest the present value of E at that point in time. Now, because we are selling the stuff, we are going to do the opposite of that. Instead of investing, we are going to borrow. So let's look at the step. First of all, sell a call and get $3 because the call is worth $3. That's the premium for it. On the second component is the present value of the exercise price. We are going to borrow that. So that was a sum of 29.2593. We calculated that on the previous side. So this is going to generate the total cash amount equals 32.2593. So with this amount of money that we have, we are going to buy the left-hand side. What do we have on the left-hand side of the put call parity? We have a stock and we have a put option on the same stock. So let's buy that. So buy a stock which costs us $30. And buy a put option, we know that put option costs us $1.75. So the total cash that we will spend is going to be equal to 31.75, which means that a difference between 32.2593 and 31.75 is the risk-free arbitrage profit, in this case approximately 51 cents. So that is pretty much I wanted to discuss in this particular session. To recap, we started the session by talking about a protective put. We said that a protective put is also known as a married put and is constructed by, first of all, buying a share of stock and simultaneously buying a put option on the same stock. And the put option acts as a protective cover. That's why the name protective put. We set up the protective put by taking some data for the Citigroup stock, and we looked at the payoffs, and then we set up an alternative strategy where we decided let's not buy a stock, let's buy a call option, and also at the same time invest some money which is equal to the present value of the exercise price. So when we set up that strategy and looked at the payoffs, we found that the payoffs were equal to the previous strategy, which led us to believe that if the payoffs for both strategies turn out to be equal, they must also have the same cost at the beginning, at the time of setting up these strategies, that is. So that led us into the put call parity condition, which said S plus P is equal to C plus the present value of the exercise price. The other thing we noted was that in order to carry out the discounting in the context of options contracts, we need to use continuous discounting, where we use a mathematical constant known as E, and you need to figure it out on your calculators on how to do it. I described the steps that need to be taken on a Texas Instruments calculator because that is the one that I am carrying. So if you have missed out on any of those steps, you can always rewind the video and go to that point in time and listen to me describe it again. So for now, I would like to end this session here. In the next session, we are going to discuss the option valuation model proposed by Messrs. Black and Scholes. For now, it's goodbye. Bye-bye.